Welcome to DWS Market Update. 4 months have passed since the trade war began in early April. Countless tariffs have been introduced, lifted, postponed, drastically increased or reduced again. What does this mean for the global economy and for investors? First, it should be noted that tax revenues in the US are now pouring in. Tariff revenues in the US amount to around 1% of GDP. This raises the question of who will ultimately pay for these duties and what impact this will have. Contrary to Donald Trump's claims, it is unlikely that exporting countries will pay. If this were the case, US import prices, excluding tariffs, would have to fall. However, this is not happening. Therefore, it's good reason to believe that US citizens will foot the bill. This could take the form of higher inflation, weaker corporate margins, which would then weigh on the stock market, or a weaker labor market as companies compensate for higher costs by cutting jobs. The latest US labor market report has already shown clear weaknesses, and economic growth in the first half of the year was only half as high as in the previous quarters. European companies will probably be able to cope with the tariffs reasonably well. Some products are difficult to replace, while for others, the US import price accounts for such a small proportion of the final sales price that the tariff-related price increases can easily be hidden. So far, the tariffs have left only minor marks on the European economy. What does this mean for investors? We expect tariffs and trade policy uncertainty in particular to continue to weigh on the global economy, but especially on the US economy. The European economy should benefit from future defense and other investments. We expect the European stock market to outperform the US market. As we also expect the dollar to remain weak, investing in European stocks is particularly attractive. With that, I say goodbye until next time.